Hello and welcome to Chapter 11, Current Liabilities and Payroll. As you can well imagine, what we've done is we've gone through all the financial statements of the business. And what we're doing now is we're working through the balance sheet. You notice that we skipped Chapter 10 in our discussion that has to do with investments. The reason I skipped Chapter 10 is because I feel like I want to make certain to cover some of this other important information with you, and I had to elect to pick a couple chapters not to cover because I wanted to make certain to go through this. In Chapter 11, what we're going to focus in on is current liabilities and payroll on the balance sheet for a business. So we're going to focus in on things that are going to come due within a year. And then also payroll and how a company accounts for payroll. So with no further ado, let's get started with chapter 11. As you might remember, liabilities, current liabilities, are of a known amount, and it's something that you owe at some point in the future. Liabilities are debts that are owed to creditors. That means you owe credit. So you have companies that you owe money to, and there's three characteristics. It's based off of a past transaction. So, for example, if you're talking about your own personal life, it might have to do with paying your utilities. That might be a liability if you were generating a financial statement for you. And it creates a payment for future cash or services, and you can't avoid it. So, one of the things you always hear about is death and taxes are unavoidable. Well, in this case, current liabilities are unavoidable. You have there's a distinguishing characteristic between current and long-term liabilities. Current are going to be due within 1 year or within the entity's operating cycle. Some businesses could have an operating cycle longer than a year. Imagine Jim Beam that makes whiskey. Do you think their operating cycle is a year? Probably not. It's going to take them longer for some of the things where they're going to have to pay their bills. But generally speaking, in most typical businesses, the operating cycle is 1 year or less. And long-term liabilities are going to be owed for a longer term. And typically with a long-term liability, you're going to have some type of interest associated with it. So that's just kind of a good benchmark to differentiate between current and long-term liabilities. If you notice on the left, you have current liabilities, accounts payable, sales tax payable, and unearned revenue. You're going to have a couple others that we're going to talk about that are not on this slide that relate to payroll. In particular, the liabilities are going to have to do with taking money out of an employee's check. For example, you might have federal income taxes payable, where they're taking money out of your check to remit it to the federal government. Your company is a collection agency for the federal or the state government. You might also have employer payroll taxes that they have to take out, which is going to be a Social Security match because they take out Social Security from your check, but they also match it at 6.2%. And they also take out of your paycheck stuff for retirement and donations, but also the employer has to pay state and federal unemployment tax. Those are all current liabilities. Long-term liabilities, in a good way, just as a general rule, not always, but a good way to think about long-term liabilities is they have some kind of an interest associated with it. Might be different for each one of these, but there's going to be some type of interest that you're going to have to pay on a long-term liability. And these just happen to be some that they've pulled out. Notes payable you typically get from a bank. Mortgage payable, that's going to be associated with some type of real property like a building or land. And bonds are really typically might be unsecured. They might be secured against some assets, but bonds are going to be sold in some type of an open market. And so if we take a look, let's talk first about sales tax payable. And we'll look at this journal entry, but then let's talk about what happens when a business sells something. So in this particular case, this business sold something for $10,000, and it looks like their tax rate is 6%. So if they sold a tractor that had a price of $10,000 on it, they collect another $600 in tax and sales tax from the purchaser of that tractor. So in effect, what they've collected is $10,600. Eventually, what they're going to do is remit that $600 to the state of whatever state it is that they're collecting the money for, and so the $600 doesn't have anything to do with the business, but it has to do with collecting money for the state. The $600 that they collect, and where a lot of businesses get in trouble, is they collect sales tax, but they don't remit it to the state government. They keep that money for themselves, and they don't realize that they owe that money to the state. and in fact they've over-reported their sales or their revenue. So, and they get in trouble because they say, well, they had to shut them down because they didn't pay their taxes. Here's one example of that. Now, when they finally do remit their money to the state, it's going to be a debit to sales tax payable and a credit to cash. Remember, the company or a company, when they collect sales tax, is really a collection agency for the state. And you notice that it says that they send this money to the state government. Well, for sales tax purposes, the federal government has nothing to do with sales tax whatsoever. It's only at the state level, and the state establishes those rates. Second one is income tax payable. If you remember when we did our financial statements to this point, we've come down to a net income number. Well, really, that net income number is before taxes. Businesses have to pay anywhere between 25 and 40% income tax on what they've made. So if a business made $100,000 and their tax rate is 30%, you're going to calculate, take $100,000 and multiply it times that 30%, and it's going to tell you that your taxes are $30,000. So where you had net income before taxes, you're going to take another $30,000 off and say that's income taxes, and then you have net income after tax, and it'll be $70,000. Well, this $3,780 is part of the taxes that they've reported for Smart Touch Learning, our company in the book. And it says that they have taxes of $3,780, and it's based off of what their income is in some type of a percentage for the taxes, and they generate a payable. And typically this income tax can either be sent to the federal government or the state government. And when they pay that bill, in this case it's March 15th, they're going to debit the liability for income tax payable, and they're going to credit cash. Remember, these are all current liabilities. Now, looks like this next one here talks about unearned revenue. And this one is for Smart Touch, where they took in $900 for something that they were going to do sometime in the future. They told the client, okay, if you want this computer, you're going to have to give me a certain amount of money down, and if you want me to get it prepped for you, you're going to have to put this $900 down, and when the computer comes in, that's your deposit, and when the computer comes in, I'm going to charge the rest of that back to you. And when I deliver the computer, that now becomes earned revenue on whatever date that they have earned revenue. And when they have earned revenue, what they're going to do is they're going to debit unearned revenue, which is a liability, and they're going to credit service revenue for the month that they did the work. So that's what it would look like. And you say, okay, so how does this work really? Let's talk about the Texas Rangers. This particular year, the Texas Rangers made the playoffs. Well, they don't. What happens is at the end of the season, if they think they're going to make the playoffs, they'll send a letter out to their fans and say, okay, the ones that are season ticket holders, they'll say, do you want playoff tickets? And if the fans say yes, then what they're going to do is they're going to say, okay, you need to submit enough money for each round of the playoffs, and we'll hold on to that. And if we make it to that round and we play that game, then they're going to report it as a revenue. But if they don't make it to that round and they don't do the other stuff, then they're going to have to remit it back to the customer and tell them, or their season ticket holder, and say, okay, that is unearned revenue and we need to send it back. They do not earn the revenue for each game until that game is played. Until that point in time, that money sits on their balance sheet in an account called unearned revenue, because they have to kick it back or send it back to their season ticket holders. And the reason they do that is they don't have enough time to say, oh, we made the playoffs this Sunday, and there's no way they can send out stuff from, say, they know like one Sunday to the next that they're going to play in the playoffs. There's no way administratively they have enough time to get all their fans tickets in order to get to the game. So they have to do it sometime in advance. And there might be a time that they collect all that money and never make it to the playoffs. So that becomes an issue as well, but it becomes unearned revenue, and they have to refund that back to their season ticket holders. Now, this next one is a short-term note payable, where Smart Touch bought some computers and they put them in their inventory for $8,000, and they took out a 10% note, a 90-day 10% note. So this is a short-term note, and the reason they do that is they may be turning around and they're going to resell these immediately. And they're using a perpetual inventory system, so that's why you see them debiting merchandise inventory. They debit merchandise inventory for $8,000 and they credit notes payable. When they pay that and the note comes due after 90 days, they're going to debit notes payable to extinguish it. They're going to debit interest expense, and they're doing 8,000 times 0.10, which is the 10%, times 90 days, 90 divided by 360, not 365. And it says their interest expense is $200, and they're going to credit cash for $8,200. You also have something called the current portion of long-term notes payable. And where you would have that is you want to put that in the current liability portion of the balance sheet. The reason you do that is it paints a picture for the business on what what's called a current ratio is. And what they're going to do is they're going to compare current assets versus current liabilities to see if what's going to convert to cash within the next year on the current asset side is going to be sufficient to cover the payment of current liability. So you take one and divide it by the other. So if you have a current ratio of less than one, let's say your current assets are 90,000, your current liabilities are 100, so that would be 0.9. That means you have a problem with your business because you're not going to be able to generate enough cash to pay off your current obligations. And for us personally, how you might look at that is you might say, what's my current income? Because that's how we would look at it. And let's say you're going to make $90,000 in a year. And I know these numbers are big, but you're going to take $90,000, that's what you make per year. And if your expenses or what you have to pay out is $100,000 per that year, you're going to be in trouble there as well. Your inbound is less than your outbound, so ultimately you're going to have a difficult time as a business and as an individual. And the remainder of that is classified as long-term in this thing. So what do we look at we're going to look at some payroll transactions. We have two different sides to the payroll transaction, and payroll is really driven by salary and compensation. Typically they won't call it compensation, they would call it wages. And a commission's a percentage of your pay. Typically that'll be for sales commission. And you have bonuses and you have benefits. Those are all things that you have to record for payroll. And it's a huge expense for a business. And we need that for employee pay. And just like the sales tax, the federal government, the employer is a collection agency for the federal government and sometimes the state government and sometimes for charitable organizations where they take money out of your check. And what that really means is you're going from a gross pay to a net pay. So the first time you guys got a paycheck, you might say, oh, I'm going to make $10 an hour and work 40 hours a week, so I should get a $400 paycheck. Well, no, not really, because they're going to take out Social Security, or FICA as it's called, Medicare, and they're also going to take out some type of federal income tax. At a minimum, those three deductions are going to come out of your check, and the percentage of those is probably somewhere between all three of them, somewhere between 25 and 35%. So what do you take out of it? Okay, so you have gross and net pay, which we talked about. Gross is what the $400 we just touched on, and net is whatever the difference is after they've taken out deductions. And you have what I would call voluntary or involuntary and voluntary, or mandatory and discretionary. I like involuntary and voluntary. So no matter what, they're going to take out of your check Social Security, federal income tax, and Medicare. And if you live in a state where you have state income tax, they're going to take that out of your check as well, among other things. Sometimes they call that what's your take home or take home pay. That's the term you might hear. So let's look at required deductions. You have federal and state income tax. Social Security and Medicare is another one that are kind of lumped together, and basically other deductions. And where I said where it says required deductions, I would call those mandatory or involuntary is a good way to look at it. And then the optional or voluntary deductions, insurance premiums, they'll take out money out of my paycheck to pay for insurance. You have something called retirement plans, and I'm not going to go into a whole lot of detail with this, but the one thing I will tell you is if you have a 401k at your company, you need to put in the maximum you can up to whatever the company will match. So if the company will match you up to 6%, you need to put in 6%. You will not notice it in your take-home pay. The first week or two you will, but not very long after that you won't notice it. Because if they're matching you, say 50 cents on the dollar, and you make, say, $30,000 a year, and you put 6% of your pay in, which would be $1,800, they will match you and give you another $900. So by you saving $1,800, the company's going to pay you another $9. So you'll have $2,700 in savings after the first year. And what I would suggest to you is not to take that out for anything but retirement. When your kids are going to go to college, it's not for them. And when you're going to buy a house, it's not for that. It's only for when you retire. So just remember that. And if you have charitable contributions, say United Way, or a donation to the university, or you could fill in the blank as far as charitable contributions that they might take out of your check. That's going to be it's going to be another voluntary or optional deduction out of the check. But each one of these, when they take it out of your paycheck, creates a current liability for the business for them to pay to whoever they collected the money for. And those are called withholdings. And what they have for income tax, for employee income tax, they look at withholding, and they look at a W-4 that tells how much they're supposed to withhold based off if you're married or single and the number of dependents. And it says here, a childless married couple usually claims 2 dependents. So I'm married and I have a child that's a dependent, even though she's 22. So I would claim 3 dependents on my taxes. And this is what you would look like. You'd see this form. You'd fill this out. I know most of you have seen this. This is what you need to fill out. Now, you have Social Security is one of the taxes that's a mandatory or involuntary deduction. And they take Social Security out of your check so that when I get old, I can retire. And when you get old, you can retire. But I doubt that that's going to be the case, that you'll have Social Security. But you hear about this all the time. And sometimes it's referred to as FICA. But they do this so that you can actually have some kind of money when you retire. Your grandparents might be on it. Some of your parents may be on Social Security. But they're getting a paycheck based off of the deductions that you get. Now, I want you guys all to work very hard and make lots of money so you can pay into Social Security so you can pay for my retirement. I would really appreciate it. Okay? So that's Social Security, and it has 2 parts. It has old age. That's for like our grandparents and some disability stuff. Like one of my friends is in a wheelchair. He gets some kind of Social Security. And then Medicare is for medical benefits. Here's what you call a payroll register. And what it does is it keeps track of what the person has made for the year, what taxes have been taken out, what insurance has been taken out, and what their salary is for the month and year to date. And they'll use this when they have a year to date for all these numbers. They'll use this to determine whether or not how to generate your what they call W-2, that you get at the end of the year that you use to file for your taxes. But they also use this to post a journal entry. And imagine what happens here is these are used, this stuff happens within a computerized system, and it automatically posts journal entries behind the scenes that are automated based off of the rules that have been established for the business. And here's what a journal entry would look like. It said for the month of December, they had $28,580. And if you look at that, if you were to put in parentheses there, gross pay, that's going to be what everybody is going to be paid between wages and salaries. And a lot of businesses will break out their wages and salaries into 2 separate accounts. And the other things are all deductions. You have Social Security and Medicare, those are the first 2. And the Social Security is 6.2%, and Medicare is 1.545%. And the Social Security is only up to, I think it's $112,700. Once you make more than that, you don't pay, but there's no cap on the Medicare. And then they took out income taxes that they're going to remit to the federal government. They took out health insurance, so they're going to send that to the health insurance company. And then they took out United Way, which is a voluntary deduction for a donation. And the bottom line where it says $20,326, you could read that if you could put in parentheses there, net pay. That's what the company, if you were to look at net pay on pay stubs, that's what you would see in your pay stubs if you looked individually. If this was just one person, but it's not, it's multiple people, but if it were one person, the $28,580 would be gross pay, and the $20,326 would be net pay. Now, that's the employee side. The employer also has to pay taxes. And they have three taxes that they pay. They pay Social Security. They match whatever you took out for Social Security. So if you go back to that last slide, if you want to go backwards after this and you look where it says Social Security, that the old age one and then the Medicare one, those two, the employer has to match what you pay. So if the company paid, if the whole company paid $10,000 for the employee, the employer is going to also pay $10,000. That's the first thing. But the second thing is they also have to pay into an unemployment fund. They have to pay into the state and federal unemployment taxes, and that's their right to pay. And they determine the what percentage they pay based off of their history of what they've had, the employees that they've laid off, and the employees that collected on the system, and they'll keep track of that and they'll pay that as well. So you can look to the left side; those are the employees' withholdings, and you look to the right on here, and that's the employer's withholdings. You see OA, so you have the net take-home pay $723, but you have $62, $15, and $200 for income taxes, Medicare, and Social Security. That's on the left side. But on the right, you notice that there's a 62, a 15, and a 6, and a 54. And those are the ones that are the employer side. So we will have to do a total of 1,137, but you would really do this in two separate entries. You would do the employer taxes, which are called payroll tax expense, and the employee side are just deductions off of their check. So the sum total, the stuff on the left, the 137 is going to be a debit to payroll tax expense. The sum total on the numbers on the right are all going to go into payables, and the offset for the ones on the right and the employer side are also going to go into the same payables. And so here's what it looks like. Payroll tax expense will look like this. And these are just the employer's expenses only. Not the employees, but the employers. That's what they have to pay for the right to employ employees. Now what do we have? There's some internal controls over payroll. One of those is that payroll is automated rather than prepared by hand. So if it's not prepared by hand, you can't play with the numbers at all. It's done automatically through some type of computerized system. And the second thing is employees have to show an ID for their check, and companies will do payroll audits to make certain that there's not what you call ghost employees, because it kind of goes, the top one is a great thing. But let's say you and your brother work at the same place, and your brother says, here, take my badge today and swipe me into work. The boss is never going to know that I'm not there, and I'll go all this week and you go all next week, and we'll each swipe each other in, if that's how you sign in or if you type in with a computer. And then when it comes to payroll check time, I'll make certain to come in and show my ID and I'll get my check. But that's a way that they can cheat the system. Now, one thing that's interesting as well is this one where it says hiring and firing is separated from payroll and payroll preparation. If the person that hires and fires can actually put a person into the payroll preparation system, they can actually game the system as well. They can make up an employee and do a direct deposit, and nobody would ever know that employee was a ghost employee, is what they call it. And the direct deposit, even though a direct deposit is good, it can also be bad unless you do this physical payroll audit. And one of the things you do is where it says employees sign for checks or present the IDs. What you'll do is for employees that are on direct deposit, if they don't come and pick up their check when you do a payroll audit, you say, okay, this next time it's going to be a live check, so they won't get they'll get a paycheck, but they have to physically come and get it. It won't be direct deposited into their account. So there's a bunch of other stuff you can do with internal control over payroll. There's some other current liabilities that need to be estimated, and we'll look over to the right here for those. You have bonus plans. A bonus is extra pay that you get. You hear it sometimes for Wall Street where they get paid bonuses. Also vacation. Businesses look at vacation a little bit differently about how they accrue or estimate what they're going to have to pay out in vacation. Some businesses don't do anything unless unless you're allowed to bank vacation. In other words, let's say you have 3 weeks of vacation and you don't use it in this year, and they say, well, we'll let you carry over 2 weeks. Well, they have to create that as a liability, because if you left the company, they were going to have to pay you out for that vacation. And they have health and benefit plans. They have pension. A pension is basically a guarantee that they're going to pay you a certain amount of money into retirement, like maybe 80% of what your pay is when you're in for a company. And most of the time, the pensions are now coming out of public companies, not private ones. Public companies like universities, colleges, schools, etc. That's where you have a pension plan where they guarantee how much you're going to make. And then you have warranties. A warranty says that on a product, maybe on workmanship or something to the like, they determine that they're going to have to create a warranty liability based off of what they've sold. So let's talk just a little bit about a couple of these. The first one, it says that assume Smart Touch Learning estimates it will pay 5% of a bonus on annual net income. So they're paying bonus on net income, and they said their net income was $315,000, and they actually did the math, and the math is wrong on here because it should be 300,000 times 5% would give you 15,000, not 315. So that one's wrong. But that's the whole concept here. They're going to take 5% times 300,000 would get you 15,000 to report the expense in the payable. And sometimes they won't pay out the bonus until maybe 3 months after the year is over. So if they wait until it's 3 months after the year is over, then that's why they have to create this payable. And remember, we're following this concept called matching. We want to match revenues and expenses. Vacation and health. You have vacation benefits. It says that it's going to cost them $1,000 a month to provide vacation benefits. So it's going to be a debit to vacation expense and a credit to vacation benefits payable. And typically you wouldn't say vacation benefits payable. It would just be vacation expense and vacation payable. Warranties are an agreement that they're going to, if something is wrong with the product, that they will make certain that to make it right. So if you were to buy a brand new car, they might warranty the drivetrain, the transmission, the drive shaft, the whatever parts that they need for the car. They're going to generate some type of warranty expense to guarantee that you're going to be willing to buy the car, and that you will, if there's problems with it, you'll bring it back. Typically, they might have stronger warranties on cars that are a new line or a big changeover. Like Kia, for example, did not have a lot of recognition and not a lot of acceptance in the United States. So they had a 10-year, $100,000 warranty on their drivetrain, which is unheard of, but that's a way that people get acceptance. They get acceptance for their car. And here's an example that they have. Smart Touch made sales on account of $50,000, costing $35,000, subject to warranties on June the 10th, and estimates warranties are 3% of sales. So what you're gonna do is you're gonna take 3% of the $50,000, which is $1,500, and you're gonna do a journal entry for warranties. And that the first part is the journal entry for the sale, which you're familiar with. It's a debit to accounts receivable and a credit to sales revenue. And you're going to debit cost of goods sold, and you're going to credit merchandise inventory. And then you also have this warranty expense and warranty payable of $1,500. And when somebody comes in and pays, when you pay it, you're going to credit warranties payable or debit warranties payable. And I don't know that I agree with this, but I think you probably are going to debit cash, not necessarily merchandise expense, but merchandise inventory. But you're going to debit or credit cash, because you're going to pay that out somewhere. And so I don't necessarily know that I agree with merchandise inventory as your credit. There could be some debate about where you would credit that, but that's what's going to happen. And then you have other contingent liabilities. A contingent liability depends on what's going to happen in the future. And you have a couple of different ways that you look at contingents. You have remote, reasonably possible, and probable. And let me talk about an example of a contingent liability. Think about this one. I don't know if many of you remember, but some years ago, a person went to McDonald's and bought a cup of coffee, and the coffee was so hot that it burned this person in the legs, and it was a lady, I think, and she spilled the coffee on her legs, and she got third-degree burns. Well, she decided she was going to sue McDonald's. Well, she sued McDonald's, And when they first, if you're a litigator or you're in the lawyer part of McDonald's, and you saw that this lawsuit came in, they would look at it and say, "Well, wait a minute. It's a this doesn't make sense. There's no way possible we are going to pay somebody for burning themselves with hot coffee." So the remote deal of that means that they don't have to do anything, and we'll talk about that in the next slide. So remote says that they do not have to disclose that they had this person file a lawsuit because the odds of them ever having to pay it are very, very low. Now, let's say over time, that what has happened with that lawsuit is it had some kind of public acceptance, and they said, "Oh, wait a minute, it's now coming to the point where this lady's just not going away, and now maybe it's reasonably possible that we might have to pay something out." We'll have to describe what happened in a note to the financial statements and say, "Hey, we had a lawsuit filed against us for this person burning themselves with hot coffee, and there might be a potential to do that, but they don't. But that's all." And then the next one is it probable? If it's probable and the amount cannot be estimated, you're going to use the same approach as if it's reasonably possible. You describe it, you put it in a note to the financial statements, and you go on. Well, over time, what ultimately happened is the McDonald's finally settled, and what they did once they determined that they were going to settle, they might have had an idea of how much they were going to have to pay. So they had to record an expense and a liability based off of what they expected it was going to be. That's going to be a contingent liability. That's one example. There's others that companies use for, say, workman's comp. Let's say somebody loses a finger when they're working, or they lose their hand working. They work in a place where they cut their finger or their hand or their wrist off. Well, they know, employers know, and the people that they work with know that there's a certain amount of money it's going to cost an employer if they have that type of injury for workers' compensation. And they will generate a contingent liability expecting to pay a certain amount of money based off of what it typically costs for somebody that loses a finger or loses a hand. And they'll generate a contingent liability where they'll debit workman's comp expense and they'll credit workman's comp payable. That's another example of a contingent liability. There's plenty of others, but those are just two prime examples. That's it for chapter 3, or chapter 11, excuse me. And I hope that your semester is going well. And I look forward to talking to you in chapter 12. Have a great day and study hard.